Hello, everyone, and welcome to this Refinitiv webinar. My name is Maria Sanchez Marin. I work for Refinitiv as EMEA Performance Director for the Enhanced Due Diligence business, and I will be moderating our webinar today. We know third-party risk programs must evolve as society's needs are changing fast. Regulation is not the only key driver any longer, and COVID-19 has accelerated this trend even further. Today's webinar follows one that we did in April that I know many of you attended, titled Where Compliance Ends and Sustainability Begins. That one was an opportunity to look at how these two responsibilities are and even need to be converging from a more conceptual perspective. Today, we wanted to look at them from a more practical one. One of the things that we discussed during the other webinar was how if compliance starts aligning more deeply with sustainability, the goal of moving from being a cost-generating center to one of value creation will be one step closer. But before we actually get into the topic, I need to run through a few logistical details, show you how this app works. From left to right, you will see a first button that's a question mark symbol. That's for technical assistance. The second is for the slides of the presentation, which you can expand by clicking on the top right-hand corner. The third one is the media player. The fourth is a Q&A button. You can submit any questions during the presentation, but we're going to wait until the end of the session to have this addressed. I'm hoping that we have about 10 minutes. The next button links to the bios of our speakers. This is followed by a Twitter streaming button. I would like to encourage you to join the ongoing conversation connecting with our @riskmanagement account. We have also the hashtag #FightFinancialCrime for live tweeting throughout the session. There is a green button afterwards. That's for the slides and other resources that we wanted to share with you. The webinar will be recorded, and we will send that out afterwards. And finally, the last button links to a survey on today's webinar, which you can take at any given time during the session, and we will be sharing it at the end as well. With that out of the way, please let me quickly introduce you to our speakers. First, we have Sasha Beslik. He's the managing director of Sustainable Finance Development at Bank Safra Sarasin, following quite a number of years at Nordea, most recently as head of Sustainable Finance in Wealth Management. Then we have Charlie Minutella, head of Enhanced Due Diligence at Refinitiv and a dear colleague of mine. And finally, we have Dave Rusher, Chief Customer Officer from Arabo, who's joining us today from the US, like Charlie, actually. Last Monday, Refinitiv launched a major survey of almost 1,800 corporations, which I would truly encourage you all to have a look at because it's really a data treasure for professionals like us. I won't get into presenting the full, very extensive results of that survey today, but I would like to use some of the insights from that survey as they relate to the topics on the agenda for today. So a quick poll question to get us started, coming from that survey. According to it, what percentage of third parties are organizations not conducting due diligence on? I will leave you a few seconds to answer so that we see, I guess, what your opinion is, what might be the practice in the sector, and then we'll see what those 1,800 professionals from around the world have replied. The majority of you answered 43%, and that's actually completely right. I think we would all agree that this figure of 43% should be much lower if we really want to have resilient organizations. You can see there on that slide a couple of other things that I found particularly interesting, like 30% of organizations see the lack of data as one of their challenges in managing their third-party risk programs, which is interesting and one of the reasons why we wanted to host this webinar and touch on data as one of the issues that we know you're worrying about. The other one, and again, I won't get into all of these things. I'll leave you to go through these results afterwards. But I thought it was interesting at the bottom as well. It says 25% of an organization's corporate value would be lost as a result of regulatory breach. This is according to the same respondents that say they don't understand, they don't know anything or much about 43% of their third parties, which seems to me that it doesn't add up. So even more, another reason to why it is so important that that figure of 43% would go down. Something else that came out from that survey and that I wanted to share were the reasons why these companies carry out due diligence on third parties. And the first one at the top of the list was protecting the company's reputational damage. I thought that regulation might be higher, but you can see that it's on the third, fourth level of importance. You can see as well other issues that are really aligned with the topic of our agenda today. You have there corporate social responsibility, you have there sustainable supply chain, you have turning your supply chain into a competitive advantage, very in line to the topic that we have today of turning compliance, turning third-party risk programs into a value creating for your companies. Even ensuring operational efficiency, I think, is very interesting given what we're talking in terms of the challenges with the looking for efficiency, for automation, of sharing information across different parts of your organization, if we're talking about compliance or we're talking about sustainability. So Sasha, in this context, and I don't know if you have any immediate reaction to those results, but I think it would be great to hear from you first about the expectations from investors regarding supplier and third-party risk networks. What are the minimum levels of due diligence that are or will be expected, in particular as regards to ESG? And what are the sort of things that investors are looking out for and demanding are in place in regards to these third-party risk programs?
Thank you very much for the introduction and for the invitation to take part in this. And as said before, my name is Sasha Veslik. I'm heading Sustainable Finance Development at J. Safra Saracen, Sustainable Asset Manager based in Zurich in Switzerland. One of the things that we are looking at, and I think this is something that will define the way how sustainable investments will be conducted over the next 5 to 10 years, is the availability of verified data that we have access to from the companies we invest in. When I say this, you should bear in mind today in the world where the growth of assets under management in the sustainable investment space has been tremendous over the last 2-3 years. There's a lot of questions posed by us, asset owners, asset managers, and also asset owners about the accuracy and validation of the data we take in as the basis of the investment decisions we make, especially on emissions that are related to carbon, climate-related emissions reported by companies in various forms and ways around the world, collected by big platforms like being MSCI or Sustainalytics or whoever. Bear in mind that this is something that is extremely important to recognize and to be aware of. None of the data available today has been third-party verified. In practice, it means that if we are going to take the data for a value it represents, we are going to make investment decisions based on that. In order to avoid some of the challenges related to that, we have conducted over the last 6 months a big work on developing a new sort of a carbon climate-related database for the companies we invest in. in some instances, we can find a discrepancy between what has been reported through MSCI and other suppliers, third-party suppliers of data to financial industry. We can find discrepancies to up to 60, 70% from what has been reported to us and what company themselves have been reported. In these cases, again, we have to make investment decisions based on information we believe is trustworthy and relevant. And if we do that, we also need to be sure that what we do is in accordance to the data that has been verified. So in the next 5 to 10 years, you will have a lot of debate about the mostly regulation related to the emissions. And currently, at least in the European Union, you have regulations on scope 1 and 2 emissions on carbon. But I think on the scope 3, which is the one that is very tricky for us, and the data availability is limited and very often poor, we will find a big chunk of untapped value for us as investors because companies need to report that, but also a lot of challenges in terms of the data verification and what it actually is out there that we need to have a look at. I'm sorry, I can't hear you.
Sorry, I was on mute. I guess one of the things that you're trying to communicate to our audience is that the third-party risk programs that they are managing and the organizations, the companies that they are part of need to be as well as transparent as possible.
As transparent as possible and as concrete as possible in what way the information that we gain access to or are provided with is accurate and verified in all possible ways so we can actually take it for the value it is.
Fantastic. And tell me, I know from seeing having researched your background, the sort of things that you were doing before, I was very interested seeing a number of years ago when you got very involved in what was happening in terms of the supply chain, for instance, in India, in terms of the pharmaceutical industry, etc. So from that sort of experience, what would be the key risks that you would say or the key issues that as an investor, you were looking out for and trying to ensure that companies running this type of very complex, very far away supply chain, what are the types of risks and the issues that you're trying to ensure that they are transparent about, that they care about, and that they address in an efficient manner?
You know, you want me to tell you a story about how I ended up in Indian prison? We can take that for some other occasion. But I'm representing the part of the investment community, and it's a very limited number of people that actually does due diligence on the ground. And I've done that over the period of 15 years. When you invest in companies, and specifically in the sectors that are quite complex, pharmaceutical industry, supply in India is one of them. You will try to understand what is actually happening on the ground. You cannot make the investment decision based on the data available on your desktop in Europe. So what we are trying to make sure when we do this is that companies are aware of the risk, but they also have a process and management practices in place to manage that. I think there are no investors in the world that will take a decision based on a certain issue is not being addressed or the management has not paid too much attention. As long as there is a process in place and we clearly see that the non-conformities have been addressed and the company's moving in the right direction, we are also willing to support that, both through investments but also being publicly supportive in the activities they do. In the same time, what I've discovered over the years, and I've been to approximately, I think I visited 160 traveling days a year. I visited most of the world, and I've been visiting most of the supply chains, the big industries around the world. There's a lot of hot air in terms of what companies are reporting, what's actually happening on the ground. There's a lot of white or greenwashing, but in the same time, I could also see that there are a lot of efforts on the ground the companies are making. They are not reaching investors. That's why I think due diligence in the investment process is something that is really needed. It is deployed by some people, some organizations, but in a very limited space.
And it looks like perhaps 2020, if already had started, and I remember a lot of discussion in Davos, for instance, about ESG being so central now, then with COVID-19, it looks like it's evolving in the same direction. It looks like all of these issues have accelerated. Do you see that in the types of companies that you invest, that the focus is really being generated and happening?
Yeah, especially in the course of this pandemic, but also I think in the months and years after this, when this stops, you will see a shift in the focus towards the social issues mostly, because you will have a lot of millions of people will be affected by this in one way or another. I think what is also clearly obvious that the companies will need to clearly state the purpose of the enterprise in terms of the social contract, the reconnecting with the societies where they operate. The ones that are doing that well will be premium in many different ways, and the ones that are failing to do so will probably in investment concept, in investment space, but also in a societal space, be punished. So it is what we are experiencing right now is a huge shift in a paradigm, and I think it will be obvious first after 2 to 3 years where the ESG or all these sustainable investment sort of a type or angle of investment will end.
Thank you. So from what you have been saying, we need data from the ground or as close as possible to the ground. We need senior management buy-in to ensure that these programs stick.
Correct.
And you see an increasing focus on social issues as we move forward. Perhaps in the past there has been greater focus as we started talking about ESG on environmental standards, but you will see a focus towards social issues. What about governance types of issues?
I mean, the social and governance issues are clearly connected with each other. Governance from the perspective of how companies managed and run, and also how the company develops its resilience towards the things like pandemics or obstructions in the market and so on. And the social issues in terms of how a company takes care of its own employees, suppliers and partners, and also its customers. So these are the sort of interlinked issues within the scope of ESG, and they will have a more prominent position going forward. And I think, previously you could basically focus pretty much last 3 years on climate and emissions and what companies are doing in that space. But I think the pendulum is sort of going in another direction right now. So you will see, we will need to do things in parallel. Climate is not gone. I mean, it's still here. But I think given the effects of the pandemics, you will see a lot more focus on the social issues.
And which ones, between environmental and social issues, which ones are the ones that you have a sense are more difficult to measure and get data about? Is it social issues rather than environmental?
Traditionally, the quantitative information is mostly provided on the environmental side, although in a very aggregated level, and very often for us investors, very hard to see if that part of the business is the one that is most intensive or energy efficient and so on. So it's on an aggregated level, so very difficult to grasp sometimes. On the social issues, the data is in many cases qualitative. But I think the way forward will be to provide the sort of economic value, or to calculate economic value of the social contracts or social activities that companies are doing in order to provide investors better understanding how that value or shareholder value is supported by that. So you will see more of innovative solutions around that. And I want to make that clear again. All of the solutions going forward will need to be, in many cases, third-party verified. Not all data from GRI reporting, but the material data that we can actually use to make investment decisions.
Thank you. So I could keep talking with you forever, but we have to move on. I'm conscious of time, and we'll come back to you during the Q&A session. Before that, I wanted to share something else. Another of the questions that we share with that we got out of that survey, where we ask about the priority sustainable development goals that the company surveyed were taken into account. And to me, many of them are very aligned with the types of issues that we are discussing, that we were discussing with Sasha right now when we talked about health and well-being. He was talking about social issues, about that social contract with the supply chain, with the providers, with the partners that companies work with. When we talk about gender equality, about clean water, sanitation, these are all of the top topics that came out during the survey as key priorities for those that responded. So, Charlie, it is increasingly clear to all of us that ESG needs to be on the agenda of third-party risk programs, like we were discussing with Sasha now. And we saw from our last webinar different grades in the alignment between which roles within a company structure will own that, measuring that risk. And the question that comes very strongly as well from Sasha now is, how do we ensure that we can practically and efficiently incorporate these ESG concerns into third-party risk programs in a matter that can be in a way that can be relied on? What is the sort of information that we need to be looking out for, and how can we find it?
Thanks, Maria, and hi everyone. I'm Charlie Minutella. It's a good question, and I think over the next couple of minutes, I'll aim to give the audience a bit more perspective on how you can kind of create that culture internally as you speak to your company's leadership and board around the importance of this topic, but then also some real practical applications of how you could try to capture this type of data. I think Sasha's point is a great one in that a lot of the information that companies are relying on today is really information that is self-reported by the target company, whether that's a target investment or it's a target third party to bring into your supply chain. And obviously there's a bit of gray area there. What's reported and what's actually happening on the ground, we tend to find that there's quite a spread there. And so I'll talk a little bit about the things that you can do to mitigate that. To start off, just to give some perspective, I think it's really important for the audience to consider that there is a real link between ESG risk, ESG controversy, and financial performance and market valuation. And we're seeing that link is becoming even clearer. There was an article in the Financial Times back in December that talked about a study that Bank of America did on about 24 or so companies that had ESG controversies. And they saw that the market value of these companies dipped by a collective $534 billion following the 12 months of post-controversy. And what we're seeing as a kind of a result of that is a controversy event will halt the rise of a stock price for a sustainable period of time. And it's looking like it's about 2 years. These companies that they looked at were performing in line with the market, but following the controversy, they had a significant drop in the stock price. Going further, we've seen, as Sasha pointed out, there's just a big interest in investing in companies that do right by society. The CEO of Bank of America, Brian Moynihan, talked about this in Davos, not last year, but the year before. At the time, they had about $25 billion in ESG funds. I suspect that's much higher today. If you look at the asset management side, the CEO of BlackRock, Larry Fink, said climate crisis is fundamentally reshaping finance, and it's becoming a major factor in terms of long-term prospects of a company. And if you think about that, I think a lot of people will automatically turn to, okay, so if I'm looking at my own company, I'm going to look at my direct operations, and I'm going to figure out the things that I need to do from a training perspective, from a policy perspective, control perspective, to try to drive the right types of behavior to mitigate this potential risk of losing market value because of an event. And as you can see in the middle slide, this came from TrueCost. The middle graphic in the slide, is that actually for most industries, their exposure to environmental risk, for example, it doesn't come from their direct operations. It mostly comes from their supply chain. You think about the ones like oil and gas and chemical, that makes sense, right? A lot of their supply chain is dealing in the environmental space, and you would expect them to have a high degree of exposure. But if you look at industries that are not necessarily supply chain heavy, like financial services, 98% of their environmental impact comes from their supply chain. So it's really important to be able to, in your supply chain risk assessment process, to be able to gather this type of information and use it as a method to reinforce your commitment to sustainability. This type of information, as Sasha mentioned, is being asked for more often. And I think you'll see on the next slide that I'll show you that it's becoming more of a regulatory, it will likely become a regulatory requirement. So for those that are not aware, the European Commission in the earlier of the year published a study on due diligence requirements for the supply chain. It's been a topic that's been talked about now for a few years. But it seems like over the last few months, really driven by COVID in the last few weeks, but even before that, there was a real drive to do this, is that we'll likely see mandatory requirements for supply chain due diligence for both the environmental and social part of supply chain. This is a really interesting study. It's about almost 600 pages, so it's quite a lengthy read. But I think that some of the things that have come out of it reinforce some of the observations we had in the survey, but also I think gives some good food for thought. So in this study, I think the sort of high-level overview is that voluntary action's not been enough. So while everyone had hoped that companies would begin to take more of an interest in identifying environmental and social factors within their supply chain, it really hasn't happened. The results look like there's a spread between what the government thinks and what those that are in charge of these types of programs in companies think. But overall, they found that just over a third of companies indicated that their companies undertake due diligence, which take into account human rights and environmental impact, and a further third due diligence on other areas. So if you combine those together, it sort of aligns with what we found in our survey, that about 60% of companies believe they're doing due diligence on other third parties, but really when you dig into it, only about a third are looking at environmental and social factors. Another thing that they found in this survey was that the majority of business respondents felt that they were undertaking due diligence on their first-tier suppliers, so their direct supply chain. But what they're not doing is looking beyond. So their suppliers, and so on, the relationships that their suppliers have, that tends to be a big area of exposure, because the further away you get from the direct relationships, the harder it is to actually document the type of processes and controls that are in place. That information doesn't always make its way up to the end company, usually the major company in the major jurisdiction. And so that becomes a big area of risk for those in industry. They also found in this that client diligence is a self-standing process. It's rarely used. So it's not taking into account this as a general part of their due diligence. It kind of is sort of part of a wider set of due diligence, and therefore that information isn't really making its way back in the right way. And then the way that they're sort of mitigating against this is through contractual clauses and codes of conduct, but they're not really making any real changes to supply chain based on the information that's coming out. So I think this is it's really indicative that the government is seeing that the steps that are being taken are not enough. The money that's being spent on due diligence, it's not enough. The time is not enough. It will need further sort of regulation, which sounds like will happen. I think some of the things that they're thinking about now is who enforces this, what is the enforcement body, who will do that. What does non-compliance look like? So if you are found that you're not conducting due diligence on your supply chain, what does that look like from a punitive perspective? And then who it applies to. I think from the some of the conversations that have had since this study was published, it looks like this is going to be applied to all companies, big and small. But I think the question is around, in terms of enforcement, are they going to look at companies that are in major industries like medical devices, medical supplies, pharma, et cetera, or are they going to limit it? So that's, I think, one you have to keep your eye on, because this will change over time and will likely materially change the way you look at due diligence. So wrapping up, I think it's important to think about what are the strategies you need to have in place to be able to collect this type of information. I think Sasha mentioned earlier that being able to rely on the information is critical. Being able to validate the information is critical. Ideally, there would be a third party, some sort of industry benchmark that would take all this information in and create almost, for lack of a better term, a utility around this data. That likely will not happen because of a variety of reasons. So companies will be responsible for themselves, for their own actions themselves, and being able to create a program that they can rely on and sort of back up what is being provided and stated. So some of the things that we're thinking about, we help our customers identify are, in terms of the supplier, we think about a variety of things. So we look at the supplier, we think about the industry and country they're in. So what's the norm? What is the risk of corruption in that country and in that industry, and what does regulation look like? Taking in all that information, what are the criteria you're looking at? What are the definitions of that criteria? What are you concerned about? On the right-hand side of this slide, you'll see some of the things that we've seen companies look at in terms of real practical questions that they can ask. And these questions may not be asked directly to the supplier in the form of a questionnaire, but it might be what they're looking at in their open source research, when they're looking at interviews, et cetera. How do they actually score this information? So how does each company come up with their own version of red, amber, and green? That could be a 1 to 10 range. It could be red, amber, and green. It could be high, medium, and low risk. Each company will have to think about the right way to score the results of their due diligence. Which questions are weighted more than others? Is a question around social weighted heavier than a question around environmental? I mean, those are all questions that you have to ask yourself and be confident around your methodology. I think one thing that's really interesting is the source of information and its weighting. I think one of the things that we see today, as Sasha mentioned, is that this information is coming in usually from questionnaires that the actual supplier is answering themselves. How much do we take that information into account? How reliable is that information, especially when we know that greenwashing is happening? Looking at other things, what's actually out there? What are the enforcement actions against this supplier? What are the litigation actions against them? Finding out if something was dismissed and taking that into account versus a conviction or some sort of public settlement. What's happening in media, social media, and blogs? This is a really interesting predicament for companies as they're looking at supply chain risk, because media, social media versus mainstream media, there's a definite spread in reliability. But looking at some countries that are heavily politicized in terms of media, there may not be that great a spread between social and mainstream. How do blogs take into account what's actually going on? Are they reliable mainstream sources or not? So being able to take that information in and weigh it, I think, is really critical. I think ultimately today there's less of a reliance on social media and blogs. I think tomorrow that's going to change considerably, because this information may not reside in any other place. And taking that information into account, taking it for what it's worth and acting on it, I think is something that each company will have to decide what their appetite is for that. Looking at NGOs is really important. I think that what NGOs publish gives you a sort of an on-the-ground perspective without actually going on the ground. And again, you have to really take into consideration what your appetite is to use that information in terms of whether or not you continue in business with a supplier or onboard them. I think that's something that each company needs to kind of take into account. And then finally, interviews, and Sasha mentioned this earlier. There's a really great perspective that you get by going on the ground, talking to not only the company itself, but also talking to regulators, talking to journalists, talking to others in the industry to understand the business practices, the environmental record, et cetera, things that are addressed locally or anecdotally in some instances, taking that information into account and being able to use it or not use it, I think is really critical as well. One thing that's not on this slide that I think is also important is how do you manage this on an ongoing basis? You can do an assessment today, but it might change tomorrow or 3 months from now or 3 years from now. And what's your strategy around ongoing change? I'll turn it back to Maria.
Thank you so much, Charlie. There are a few questions coming in. Just a reminder to everyone to go to the Q&A button if you want to pose any questions to any of our speakers, and we'll take those up towards the end of the section. So we know that supply chains and partner networks are becoming increasingly complex, and this is, I think, coming up through this conversation. We're seeing that the expectations on companies to understand who they are doing business with is increasing exponentially. And we know as well that resources are limited. And it looks to me that automation is the only way to ensure that we can take into account that we can address all of these concerns and ensuring alignment across the different parts of the company that we're concerned with. One of the things that came out in the survey that we were talking about before was the types of challenges that third-party risk programs were facing. And I think quite a lot of these challenges link up with that issue of automation. I have highlighted there a few, like resource constraints, including budget, including time, building up a holistic view of risk for a third party, sharing risk information across different functions within your company, or ongoing monitoring. And Charlie was just talking about that, the ongoing monitoring for a new risk once a third party has been onboarded. So with all of this in mind, Dave, I think it would be great to hear now from you, have your expert opinion on the challenges that you see being better addressed through automation, through technology. How do we make third-party risk programs more efficient thanks to automation?
Yeah, thanks, Maria. And thanks to everybody for being on with us today. As mentioned earlier, I'm our Chief Customer Officer here at Arabo Solutions. And we spend a lot of our time actually working with large organizations like those which you represent, automating their third-party risk management programs. Is probably most important and maybe the most obvious about applying automation to this challenge are the three areas that automation can really impact the most are executing these programs at scale, helping address the complexity that exists within these programs, vis-a-vis the complex relationships that exist between yourselves and your third-party ecosystem, and then addressing and automating the change that is inevitable when it comes to third-party risk management. And that's really where we spend the bulk of our time with working with our clients and with the market, are addressing those three primary challenges of scale, complexity, and change. And solutions, as you look to build your third-party risk management programs, they need to address that full life cycle. So we talked, you hear a lot about conducting the due diligence associated with your third parties. Who are they? Where are they? What types of product services? How risky are those? But it's important that all of that due diligence happens both at the point of initiating a relationship or even in advance of initiating a relationship with a third party, but throughout the relationship as their business will change and your business will change. And that's the concept that people were talking about, ongoing monitoring or continuous monitoring. We like to refer to that as always on monitoring. It's a really important facet here because your relationships aren't static at any point in time. And increasing concern, we've talked a lot about the third-party relationships that you have, but those third-party relationships are also impacted by the relationships that they have with their subcontractors, subsidiaries, partners, etc. So these fourth or nth parties can impact the veracity of your supply chain just as much as your direct relationships. And it's important that you have a technology or an automation solution that can enable you to conduct increasing amounts of due diligence as appropriate against those fourth parties. The holistic view is really ensuring that you have all this important data in a single place. Makes it much easier for you to get a handle on the complete picture of the risk with a specific set of third parties with an industry across certain risk domains. It can also help when you've got everything in a centralized view to eliminate some of the noise. So you don't necessarily need to be conducting due diligence on 100% of your third parties, but having everything in a centralized repository can help you make informed decisions about the percentage of your third parties that it's practical for your organization to invest your resource and time in conducting due diligence. Some of the more interesting things that are happening in the space as we see it today are the identification of these emerging risks. So it's not just responding to it's not just your third parties responding to online questionnaires. We do an awful lot of that, and that is an important part of all of these programs. But actually, it's infusing the information that you have on hand about your third parties with other information that's available out in the market. These can be things that are identifying potential geopolitical disruption, pandemic events, earthquakes, all these types of hazards that could exist and impact any of your third parties. Having a solution that incorporates those risk indicators is increasingly important. It's just been exacerbated, I think, by the COVID-19 pandemic. I mean, finally, all of these things require investment. And so it's all about how can you get the best return on that investment through the application of your resource and the efficiency of those resources and the capital that you invest in this to ensure that things are standardized, but they're incorporating multiple inputs, internal inputs and feedback, responses directly from third parties, as well as some of these risk indicator sources that exist in the market. We like to think about that in terms of addressing that complexity. It's important to recognize where you might be as an organization with respect to your maturity or your readiness to deploy all of this technology or any of these programs. And so we break this out across 4 levels. We also have a pretty robust methodology associated with identifying specific degrees of maturity with respect to third-party risk management. But at the high level, we like to look at it as level 0. Is really just about putting a program in place where you've standardized the type of information you want, and you're centralizing it in some place that you can start to analyze and get that holistic picture for what's going on. And we've talked a little bit, Sasha mentioned earlier about the incorporation of some of these ratings around sustainability, whether it was Sustainalytics or EcoVadis, to name a couple of the popular ones. But infusing that external information, that externally available information with your third-party repository is really important. And we see that as really becoming a more important part of that level 0 data gathering. So that's putting together a better picture about the information that you could use to make decisions on your third parties. Level 1 is applying all that information you've gathered and putting it to use within your organization. It's routing it around to the various different subject matter experts across departments or across divisions that have more experience, more domain experience and expertise in verifying and conducting the due diligence on the information that's been provided. And automation can really come into play here in terms of guiding all of that information to the right person to see it. And again, eliminating the noise comes back to rules-based triggering, so that you're establishing the appropriate thresholds for review corresponding to your own internal risk register and control framework. If we move down or up the maturity chain, if you will, level 2 is about applying analytics to that information. And so you can see how these things fit together. You've got to establish the data. You've got to be able to make decisions or route the information for review and verify that data. And then you can begin to put together an analytical picture about what that information presents to you in terms of the decisions that you need to make. And it's important that those analytics eventually become the trigger for that type of due diligence. This can help you apply the right resource, the right tools in the most efficient and effective fashion to solve the concerns that you have or to control and mitigate the risks that arise. So that's a more advanced degree of maturity by the time you get to level 2. And level 3 is really where we see the market emerging to today, which is once you've gathered all this information and you've begun making risk-based decisions based on the analytics of that, you can apply various different artificial intelligence or machine learning algorithms to it to assist in the prediction of risk that may exist and help you become more proactive in terms of implementing risk mitigation or risk avoidance strategies. And so it's important to consider both the challenges associated with scale, complexity, and change. Those are the things that will definitely need to be addressed. But it's important to as you begin the journey or continue your journey in terms of automation, to be honest and appropriate about the degree of maturity that your organization has established in order to make the right investments in technology and people to solve these problems. And I would just say just a couple of practical applications that we've seen and we're working on in conjunction with some of our clients are spot on in this area. We've seen it's not just our company at Rabo, but many companies are looking at how do you infuse a lot of the information that's available in the open market to proactively respond to the supply chain disruption events. So solutions like supply chain resilience are becoming more standardized in the market, and also the application of technology comes into play in agile ways. So if you've managed to establish even level 0 or level 1 maturity with your third-party risk management program, executing and implementing programs quickly and effectively are really they're really possible, or they're more practical. So if you've gathered all this information up in a single place, it becomes very easy to do certain types of impact assessments, such as the impact of the COVID-19 pandemic on your supply chain, the issuance of those impact assessments to get real responses from third parties in terms of their profile or their posture. Where are they? How are they being impacted? What are their plans? Those things can come to life a lot more quickly once you've established certain degrees of maturity in your program. And I would just say some of the good examples that I've personally worked with over the years are represented here on the screen. At Ford Motor Company, a lot of suppliers, all those suppliers are critical in terms of the vehicles that they have to manufacture, and ensuring that those organizations through their supply chain are healthy financially from a safety and quality perspective, aren't organizations that are going to have their brand showing up negatively in media. All important. Unilever is a company with whom I've worked closely, and they established years ago their own responsible sourcing assessment, looking at things like wages and human rights and labor rights, and having a program that enables their suppliers to self-select their degree of maturity that they want to establish, or their degree of certification they want to establish with Unilever. And Microsoft, obviously a well-known brand throughout the world, but they've also taken a real focus on responsible sourcing and sustainability within their business as well. So there are some good leads in the market. You can find good information about these even on all of their websites. Actually, they do a good job of promoting their approaches to these programs for their suppliers as well as the public. It's an important part of all their brand image. So Maria, I'll turn it back over to you at this point. I think we're just about on time for Q&A.
Perfect. Thank you so much, Dave. So we have a number of questions coming in. I'll go through those now. We have one maybe for you, Sasha. Based on the fact that the goal to reduce corruption is reduced to a sub-goal in the UN 2030 goals, do you experience that companies have reduced their efforts in anti-corruption?
If they have reduced their efforts in fighting the corruption issues in their business, it's very difficult to say. That's one of the most complex things to assess. Usually as investors, you don't have that type of access to information that you would need to be able to make that assessment. What you have is the information on the processes and compliance measures that companies have been implemented in their business. in order to support the activities. But I wouldn't say it has disappeared. I think it's there, but it's not. It's depending on the sector. I mean, if you take telecom sector, it's a very important thing, given that telecom companies usually need to renegotiate contracts with the governments in various places in the world. If you take other sectors, it's not necessarily the first thing that you would look at. But I think it's more. It's there.
Thank you. Charlie, I have one for you. Is Refinitiv thinking of including credible blogs as part of their media search?
Yeah. So I think just to add on, before I jump into that, Maria, just to add on Sasha's point, I mean, from our perspective at Refinitiv, we don't see any sort of reduction in anti-corruption efforts, especially as you see sort of the regulators not sort of taking their foot off the gas in this area. I mean, you saw the Airbus fine from the Department of Justice earlier or later last year, and that's, you know, that was one of the biggest fines ever. So I don't think you'll see anti-corruption, anti-bribery changing. To your point, yes. So we are thinking about the wider sources of information that need to be taken into account. And that includes things like blogs and sort of independent analysis of certain companies or industries. This information is really valuable, especially if you think about NGOs that may not be, they're not media, and they certainly have a bias in a lot of instances, but the information they're providing, especially if they're talking about firsthand accounts, could be very valuable information to you. And I think you as a company need to decide how much you're going to take that information into account when you're looking at your program and the reliability of that information. But yes, we plan on, and we are, providing that information in our analysis to customers so they can understand what is really out there and then they can make a decision on how to take that into account.
Thank you. Sasha, perhaps one for you again. How do you implement due diligence to support investment decisions in tech companies, given the limited physical supply chain?
Yeah, that's the very important and very good question, because for most of the investment community, assessing the tech companies and making the diligence on how these tech companies deal with privacy issues or issues related to data storage or even things that are related to their CO2 emissions and the energy dependency, it's not always the easy thing. So this is the sort of up to each investment organization and based on their ability and capacity to make these assessments. And bear in mind also that the financial industry has also ability and capital to allocate to buy services if needed, if these big investments in non-listed or listed companies are made, in order to obtain the best information possible how the companies are managing a certain type of risk. So what I'm saying with that is that if we can't assess it, because we don't have the capacity and knowledge to do it. There are people who are able to do that, and we are able to buy that service from third parties that are credible in the way how they assess this.
Thank you very much, Sasha. There is a question asking if the results of the survey include distributors, resellers in the term third-party risk, or is mainly intermediaries such as agents and similar representatives. No, so we took a very wide definition on third-party risk, and it includes all of those types of roles across the supply chain, so looking both upstream and downstream. Another question, what performance measure systems and KPIs do you recommend? Any of you who would fancy that question?
Charlie, I can take a stab. Yeah, I don't know, Dave, why don't you go ahead?
Well, I was just going to say performance it's increasingly important, but I would say it's followed on the heels of risk management in terms of its priority based on what we've seen. I say some of the common things that we see companies leveraging for performance characteristics tended to be more quantitative in nature. They were things that were coming out of their ERPs primarily, things like on-time delivery, fulfillment of orders, order correction, amount of spend. So those have been the traditional quantitative factors. But I would also say that we're seeing an increasing number of programs leveraging qualitative responses through a similar type of model that you would see with third-party questionnaires that have traditionally been pointed at risk domains. So in getting feedback internally from your relationship managers of each of the third parties, as well as feedback from the third parties themselves in terms of how it is to commercially transact business with you, all of those qualitative facets factor into to performance as well. So that's what I've seen. I don't know that there's any specific solution that I've seen dominate that area to date. It's been a collection of kind of various different systems to provide quantitative as well as attempt to get to the qualitative value of third-party relationships.
I would agree with that
Thank
as
you.
well, Dave. And I think that's one of the big things here that we saw in the report from the European Commission is that there's such a heavy focus on things that are sort of like as Dave mentioned, kind of commercial or quantitative. But that's really not what the regulators are really asking for. I mean, they're asking companies to take a look at the things that are less quantitative, being able to come up with a proper assessment or score. So from a KPI perspective, I think we're at the starting point here. So just looking at what criteria is important to you and creating some sort of model of assessment is probably step one for a lot of companies. But then being able to create some sort of scoring around the qualitative side and being able to use that and benchmark that across the entire supply chain is critical. And that might be reserved for companies that are at a different stage at this point.
Thank you, Charlie, and also just very quickly, one more minute for Q&A. How important is the financial situation of the third party? And I open that to all of you as well.
I think it's a
Dave,
really
do you want
important
to
part
take
of it.
that one, or Charlie, go ahead.
Sure. So I think it's a very important one, and I think that's one that's always been accounted for. I think you're always asking your suppliers, your distributors, what their financial health is. It's a question, that's been asked for a very long time. I think the question is being able to correlate that financial health to their ability to deliver on some of the environmental and social programs is critical. It's very hard to imagine that a company that's in poor financial health is going to really be able to devote the effort that's needed to ensure they have the right social contract with their employees, that they're taking the proper steps from an environmental perspective. So I think financial health and that correlation between being able to do the things that are important in the new sort of business world is critical to look at it and try to draw that line to.
Thank you. Does anyone else want to come in? Okay, otherwise we will leave it at that because we're really running out of time. Before we wrap up, I wanted to share a question with you. We see this event as an opportunity to build a virtual community with all of you, and we want to ensure that the topics that we speak about are driven by your interest, by your needs. So I would love to have some feedback on the topics that you're keen on as regards to third-party risk. And we have listed some of them here, some of the things that we're starting to think about doing other webinars on. So could you please let me know which ones of these resonate with you? I have just listed 4 there. If you have any other sort of topics that come to mind that you're keen to hear us talking about, please feel free to share those at the end or immediately through the feedback mechanism that we have for the webinar. Okay, so that's very interesting. And to the question that was coming someone in the audience in terms of corruption, it's interesting that quite a lot of you, and we have hundreds of you online, are very keen to hear more about corruption. So that would help. That will help to answer that question in terms of how important that issue is. We do have, so good to see the interest on green crime as well. We have someone already in the works, a webinar in the works in a month's time probably, which we're preparing, building on a session that we did in Davos this year. So more on that coming soon. Now, unfortunately, we have run out of time. Thank you all for joining us today and for all of your questions, for all of your feedback. I would like to really thank Sasha, thank Charlie and Dave for their insights. The webinar recording will be available online. If you would like to receive the recording and other accompanying materials, or if you would like to speak to a Refinitiv risk specialist, please submit your details on the survey that will appear on your screen once I finish speaking. Otherwise, thank you so much again for joining us today, and take care.
Thank you.